Good morning, happy Friday, and welcome to Sunrise Small Talk episode number 71. It is scorching hot now. Remember the episode I did, I don't know, maybe 10 episodes ago when I talked about how green it was and how the mountains had snow, but the lower parts of the mountains were green and the sky was blue and it's beautiful. It's not like that anymore. Now we just have fires. It's that season. Anyway, episode 71 is going to kick off a series about OBBB. OBBB is one big, beautiful bill. There's 17 provisions that our friend Debbie Taylor over on the Carson tax team put together. And we're going to go through those, obviously not all at once, but what I'm going to hit today is there's no tax on Social Security, no tax on overtime, no tax on tips, no tax on car loan interest. What does that mean? Obviously, that is not exactly how it's written, and there are some stipulations around it. So let's dive into those. We'll give you some numerical examples and walk you through what the rules actually are. All right, let's start with one that is a little bit easier than the others: tips and overtime. Here's what you need to know about that. A little side note about this. When the Secure Act came out in 2020, or the CARES Act, I guess, the Secure Act 1.0 before that, 2.0 before that, this stuff comes out, and then my industry, the CPAs, we all sort of interpret it in different ways. And then a couple of years later, the IRS says, no, that's not what we meant about beneficiary distributions, RMDs from IRAs. We meant that it's supposed to be like this. So we all kind of learn together. I think there will be a lot of that with this stuff, but here's what I can tell you right now about it. We have our tax planning tool does a great job of figuring this out for us. So we don't really have to figure it out. I don't have to figure it out. You don't have to figure it out. You just have to give me your tax return. I upload it in the system. Our system automatically calculates and gives a simple green or red. Do you qualify for this or do you not? So that makes things very simple, and they're very much on top of these rules as they progress and as we get as some of these things get a little bit more defined. But for tips and overtime, $25,000 deduction and income limit of $300,000. Everything, all the numbers I give you are going to be speaking to married filing jointly. You can pretty much divide by 2, and that will give you the number for single filers. What does that mean? So a $25,000 deduction. Let's say I am married. It's a husband and wife, both work at a restaurant and collect tips, and each makes $50,000 a year. Well, we're going to get a $25,000 deduction there. Now, looking at this, it doesn't actually specify whether we could deduct 50 because there's 2 of us. We're only 25. So it begins the fact that there's not a lot of clarification. The way I read it is that 25,000 is total for a married couple. It does, however, specify it when it comes to overtime. That 25,000 is for a couple. The income limit of 300,000. If you make over 300,000, you no longer qualify for that deduction. So that deduction just comes right off the top of our income number, obviously reducing taxes. Let's dive into Social Security and how that is not taxed. All right, a numerical example for Social Security. There is an increased deduction for seniors, 65 and over. What if, when do you have to be 65? You have to be 65 by the end of the tax year to qualify for the additional deduction. Also, I'm going to go back to bullet point number 1 that I skipped over. And all that is that the rates and the tax brackets that were put in place in 2018 are extended through 2028. And most of the things I'm talking about here will be in place 2025 through 2028. Some of them actually stop a little bit early, but it's safe to assume that these things will remain in place from now until the end of 2028. Social Security. So what is our standard deduction? This is a number right here, $31,500, that all of us have the ability to just deduct from our income. If you itemize, you can deduct more than that. You get to pick whichever number is higher. That also brings up another point that I'm forgetting. All of these deductions are available whether you itemize or not, which is something that was kind of surprising to me. So you get to double dip a little bit. You can take your standard deduction of $31,500, you deduct that, and typically that was kind of it. You couldn't take anything else unless you were itemizing, which means you took all your deductions, added them up. It was larger than $31,500, so you took that itemized deduction number. But in this scenario, you can actually take the standard deduction, tips, overtime, car loan interest. I think there's a couple other provisions in the tax bill that you can actually tack that on to the $31,500 standard deduction. Seniors, this existed before. You get an additional $3,200. If you're blind, I believe you get another $3,200. Again, these are joint numbers, so you both have to be blind to get the additional $3,200. And this part is new, this $12,000. This is how the math works to say Social Security is not taxed. To actually change that and make it not taxable would be nearly impossible. So just adding an additional deduction was the way to circumvent that. So if we do the math here, seniors turning 65 this year, $31,000. Everybody gets that. You don't have to be 65. You do have to be 65 to get the additional $3,200, and this part that is new, the additional $12,000, $6,000 for both spouses, for a total of $46,700. That is a massive deduction that is standard, and we just get it. We don't have to do anything to receive it. This phases out if we make $150,000 married filing jointly up to $250,000. It's going to phase out. So let's say you make $200,000 married filing jointly, you're going to get half of that, because that is halfway between the $150,000 and the $250,000. Once you hit $250,000, you do not get any of that additional $12,000. What is that number based on? Is it based on my gross income? No, it's based on something called your modified adjusted gross income. All of these are going to be based on modified adjusted gross income or adjusted gross income. Here's the neat thing about that, is I can't tell you what that number is when I look at your tax return. The software can, but there's actually 7, 8, 9 different versions of MAGI, modified adjusted gross income. So good to have the tax team that we have at Carson, in addition to some of the tools and resources and softwares that we have that can tell us whether or not we qualify for those things. Last, I saved the best for last, because as you know, I love cars, and I'm going to talk about what that deduction looks like for the car loan interest. I am super excited for this part of Sunrise Small Talk, because I had totally forgotten that when I started this, I used my cars all the time, my little props. And here they are, because this relates directly to what I'm talking about. So here's the stipulations you need to know. I had somebody ask me, client's construction company, and they said, we're going to buy a whole new fleet of vehicles and we're going to take advantage of this. We're going to get a $10,000 deduction per car. Well, no, you're not, for a lot of reasons. And here's what that looks like. And here's how you can do the math to figure out a few things. Should I buy new or used? Should I lease it? What kind of car qualifies? So number one, if your income is over $200,000, scratch it. Not going to work. There is no phase out. Once you hit that limit, you just can't. This won't work for you. You don't get to claim the deduction. $10,000 is the maximum that you can deduct. So I'll show you what it would look like to get to $10,000 in interest on a car loan. It's got to be finalized in the USA. You can actually see that number on the window sticker. It says final assembly in whatever, Detroit, Michigan, wherever it may be. It's got to be new. So the question of, well, do I want a new car, or guilty of looking at new trucks recently, because mine's got over 100,000 miles now. The new one, I could probably save $10,000 on the purchase price, but then I would be giving up the deduction. So what makes the most sense there? Can I buy it for my business? Can I put it under the business's name? No, you can't. It's got to be for personal use only, because we get other deductions and incentives for vehicles that are owned by the business. So numerical example, number one, here's what I thought about doing. My Bronco, my 74 Ford Bronco, I thought, what if I sell that to myself, extract some cash from that vehicle to use for other things, and then deduct the interest on that loan? Can I do that? No, I can't. It's not new. Can't do that. What if I decided I'm going to buy a new Ferrari because I get a little bit of a tax break on the interest that I would pay on that? Can't do that. Ferrari final assembly is not in America. So numerical example, $75,000 vehicle, 7% interest rate. What am I going to pay in interest every year? $5,250. Well, to take full advantage of that $10,000, let's buy 2 cars. And then that way we are over the $10,000 in interest that we can deduct. Now, is it good to pay interest? Probably not. We have to look at paying cash and taking that money out of investments versus paying interest on the loan. That's a decision people have to make. But if we're planning on getting a new car anyway, and we're deciding between a Toyota that we love and a Ford that we love, we might as well go with Ford, because at the end of the day, we'll have an extra $1,000 or $2,000 in our pocket. So there you go. Let me know if you have any questions or you have any scenarios. I love running these types of scenarios. So if you're thinking about a car, have a kid who's curious about how the working at a restaurant, curious about how the tips work, let me know. I love going through these scenarios and running it in our analyzer. So there you go. We'll dive more into OBBB in the coming weeks. Take care. Have a great weekend. Feel free to share this with friends, and we'll see you next time. Bye.